Hi, my name is Joe Vitrano. Today I will be pitching Arch Capital Group, ticker ACGL, in the international financial sector. Let me talk a little bit about my screening process. So I started with the notion that financials really have been crushed recently due to this low interest environment, but there still is potential for growth in the insurance business, and that's because the premium market doesn't necessarily correlate to the interest rate market. And another trend that I notice is that single family real estate market has been really robust. We're seeing increasing in prices along with a lot of pent up demand. And connecting these points together, I realized that the mortgage insurance market has really high margins, and so that the mortgage insurance market might be a good place to look for a stock. And that's where I found Arch Capital Group, the largest mortgage insurer in the U.S. Let's move on to the company overview. So, Arch Capital Group was founded in 2001, and they're headquartered in Bermuda. But most of their revenue comes from the United States, followed by Europe, which is comprised of mostly the United Kingdom, followed by Ireland. And the rest makes up the 20%. So 10% is coming from Bermuda, and the other 10% is coming from the Asia Pacific market, specifically places like Hong Kong and Australia. I'd like to talk a little bit about Arch Capital's products, and they have three core products: insurance, reinsurance, and mortgage insurance. As you can see, insurance makes up the largest portion of the revenue, and it also has the highest average combined ratio. The combined ratio is essentially the costs that the company incurs by underwriting the insurance premiums. So it's essentially the costs of doing business. So 108% seems pretty high, but this has really been impacted by a soft market and will be improving soon as the insurance market is firming. Now, the reinsurance market is very similar to the insurance market in that it is covering the same areas: property and casualty, construction, energy, and marine. But instead of doing the direct premiums, they're actually covering other insurance businesses' losses. So, reinsurance is a way for insurance companies to spread their risk amongst other companies. And lastly, in the mortgage segment, you'll notice that the average combined ratio is much lower, 42.2%, and this is an average. In 2019, it was less than 30%. So the mortgage business is truly lucrative in a normal economic situation. And there is mortgage insurance in Europe and Hong Kong as well as the US. The insurance market and the insurance cycle are critical for Arch Capital and their competitors to manage. During a soft insurance market, there's going to be higher competition, lower rates, and lower risk. And during a hard insurance market, there's going to be lower competition, higher rates, and typically higher risk. An example here might be the California wildfires catastrophe market. Now, Arch Capital has a history of managing the insurance cycle extremely well, which is critical in order to have higher premiums to match the amount of losses that you would expect to see. Now I'd like to talk a little bit about my drivers. While the pandemic has increased mortgage delinquencies, they are abnormally lower than expected. Within the company's portfolio, the delinquency rate of 5% is nearly one-third lower than expected. The real estate market is supporting this trend, as median house prices are presently higher than before the COVID-19 outbreak. The lower interest rate environment also promotes lesser payments, as encouraging home purchases. These factors allow for the ability of homeowners to more easily sell their homes, allowing Arch to lower claim payouts. The combined ratio has gone up significantly in quarter 1 and quarter 2 of 2020. This is because Arch needs to provision for potential losses, which hits their bottom line. However, this should trend downward into 2021 and 2022 as the delinquency rate begins to fall. Moving on to risk management, management has modeled an improbable 20% mortgage delinquency rate at which the firm can still operate profitably, a rate that is higher than the level observed during the 2008 financial crisis. Other firms cannot withstand high delinquency rates and would have insufficient reserves to provision against such losses. Part of this is due to their ability to package mortgage insurance policies into insurance-linked securities through Bellemeade Re. Through Bellemeade Re, the company can take a maximum loss of 60% of gross premiums while only being responsible for 20%. Arch Capital was also recently able to raise $1 billion in senior notes, highlighting their access to liquidity. This capital can be used to support new underwritings and for new inorganic growth opportunities. Lastly, underwriting income. Underwriting revenue on a core basis grew 17% year over year in quarter 2 of 2020. While actual revenues were hindered by poor performance from the traveler's insurance offering, it is expected that in 2022 there will be more travel conducted around the world, which will vastly increase net premiums and lower the loss ratio. Arch Capital is also looking to expand into the Asia Pacific market with their acquisition of PMAP. This is a digital marketing firm for banks and insurance companies that is headquartered in Sydney, Australia. They will be able to use their services to penetrate a new market and continue to grow their book. The competitors for Arch Capital Group fall under 3 buckets: mortgage insurance, multi-line insurance, and reinsurance. You'll notice that under mortgage insurance, I have names like MGIC and Genworth Financial that are not bolded, and this is to indicate that they are in the same market, but they're not good enough to be in the comparable section. Arch Capital stands out from the multi-line insurance companies with their mortgage insurance business, which is incredibly profitable. Reinsurance, while profitable in the short term, lacks long-term growth. By being in all 3 of these buckets, Arch benefits from higher margins and diversified risk. On the current slide, I have a table of how I conducted my valuation for Arch Capital Group. A note on valuation. While there is no common dividends, the company does engage in share repurchases, which are based on market condition versus opportunities. Arch prefers to let the investor have control on realizing tax liabilities. In 2020, the share repurchase program was paused, but there is over $900 billion left that is likely to be deployed in 2021. It is important to mention the risks facing Arch Capital Group. The first one being the overall economic conditions. The economy plays a huge role in the firm's ability to generate income through their mortgage segment. If the unemployment rate doesn't continue to trend downward, the firm will suffer from lower income. The trend of lower interest rates also means less investment income for the company. The second risk, being the Corona Clause, could create losses for the company if their virus clause doesn't uphold in court. While the vast majority of their policies have little to do with the pandemic, some of their health and travel policies do. Travel and health makes up 5% of Arch's revenues. The last risk being the changing weather conditions due to global warming. The California wildfires have continued to get worse year after year. The firm, though, does provision for losses, as the fire season happens every 4th quarter. The total losses from Hurricane Laura and the California wildfires are expected to be $100 to $200 million, representing a 25-cent to 50-cent drop in EPS. Touching on management, Mark Grandison has been with the firm since 2001, when they began. He worked his way up the ranks to become the CEO and a member of the board. He has prior experience at Berkshire Hathaway and an 82% approval rating on Glassdoor. Management is critical in the insurance business, and is reassuring to know that Mark Grandison has such a rich history with the company. Let me finish by speaking to why I am recommending this stock. There is a great opportunity in Arch Capital Group, a mortgage insurer with insurance and reinsurance offerings. This complementary package presents the best of both worlds in the insurance industry: returns and reduced risk. Their book value has grown at a 5-year CAGR of 12%, soaring well above their peers. Now, because of the unfavorable economic conditions, the firm has been discounted, creating an excellent opportunity for the AIM International Fund. Thank you for listening, and I look forward to responding to any comments.